Equity Bank has reported a 24% decline in profits for the financial period ending 30th June 2020. The drop in profitability is a reflection of an industry that took a position to protect itself from expected loan defaults as the COVID-19 pandemic hit home. Let's get some more understanding from Faisal Ahmed on this issue.
The listed lender posted 9.1 billion shillings in profit after tax compared to 12 billion shillings it posted in a similar period last year. Net interest income, however, went up by 17% to 24.6 billion shillings, up from 21.1 billion shillings last year, with the lender registering 22% growth in their loan book from 320.9 billion shillings to 391.6 billion shillings. Equity joins the group of lenders that have in the past week seen their profits decline in the first 6 months of 2020. KCB Group led the pack in declaring a 40% decline in its profit after tax by posting 7.6 billion shillings compared to 12.7 billion shillings posted last year, reporting a 3.6% decline to 7.2 billion shillings in a similar period. Just like Stanbic Bank also posted a 37% decline in the period to 2.55 billion shillings compared to 4.06 billion shillings it had posted in a similar period last year. Underlying this performance, the lenders say they included higher loan loss provisions to cater for unexpected defaulters during the initial phase of the COVID-19 pandemic.
The issue is that on our provision levels, this is something that we think we have to be conservative today to provide for the eventuality of losses. What we are seeing now is perhaps the lowest level of performance in the first 6 months. We expect to learn slight recovery in the third quarter. And as we go into the end of the year, we've been able to assess the best positions of our businesses.
In the period, Equity Group had a 773% increase in its loan provision from 900 million shillings to 8 billion shillings. KCB Group, on the other hand, raised its provision for a potential loss of 3.6 times. Stanbic Bank, on its part, put a cover of 61% to 1.98 billion shillings. Cooperative Bank, on its part, raised its loan loss provision by 57.9% to 1.87 billion shillings from 1.18 billion shillings.
The depressed income levels. Number two, higher expenses, mostly the provisioning levels for the banks. In terms of income levels, I think banks have come under a lot of pressure, especially on the non-interest income side.
Cumulatively, the Central Bank of Kenya says loans worth 844.4 billion shillings by the end of June, an equivalent of 20% of their loan book, highlighted the depth of economic hardship in the COVID-19 pandemic has brought to borrowers. On the flip side, Family Bank defied the norm, registering an impressive run in the first half of 2020. The lender announced a 75% growth in the first half of the year to 638.6 million shillings from 364.4 million shillings last year. The share price in earnings is attributed to higher interest income from higher lending in the period. Like its peers, the bank increased its loan loss provision by 32% to 451.4 million shillings. Faisal Ahmed, Citizen TV, Nairobi.